time to maximize profitability and cash flow. It's time to learn habits and hacks from the best e-com CEOs. It's time for Return on Podcast with me, Tyler Jefcoat. All right, guys, we are knee-deep in the series walking through how to use your financial statements to make better choices to help your business get healthier. We walked through the P&L. Last week, we started talking about the balance sheet. I want to continue that discussion today on how to use your balance sheet well. In particular, today, we're going to look at the liability and owner's equity side of your balance sheet. Let's dive in. Reminder here, your numbering logic needs to be consistent on your books. And, if you're using Seller Accountant or any normal standard accounting system here in the States, you're going to have your 1,000s. By the way, it doesn't matter if you choose to do like 10,000 or 100,000. I would just say pick the same number of digits consistently across all of your accounts. Assets are going to start with the 1. Liabilities and owner's equity, which is what we're going to talk about today, are going to be your 2s and your 3s. Let's take a look at how this works. So we talked about assets last week. We're talking about how to look at things month over month over month to look for problems, look for accounts that aren't moving, look for accounts that are negative and it doesn't make any sense. And you're trying to figure out why is that account negative. This should create questions that you can then bring to your accounting sheet. So let's look at a couple of different balance sheets here and I'll give you an example. You get to the liability. And, for this particular seller, we have a lot of credit cards. We're leveraging a lot of fairly low limit credit cards to fund the different aspects of our business. And, the result is that we're carrying 6 figures per month in credit card debt. And so there's 2 things I want to make a point here about credit cards. One is if you look at this one credit card here from Bank of America, it has a negative balance that isn't changing each month. Just want to remind you, this is what we talked about last week. That is almost certainly some kind of an error that needs to be corrected. And that would be hold on, accounting team. I want to get you to take a deeper dive into this one. It's highly unlikely that Bank of America owes us $1,492 and has owed us that for the last 5 months. That's highly unlikely. And so there's probably something that needs to be reconciled amongst all 3 of our Bank of America accounts. Because sometimes that's what happens, right? Sometimes Bank of America will give us 1 line of credit, but they'll actually issue us 3 or 4 different credit cards that are all drawing on the same line of credit. And it takes a little bit of additional work as an accounting team to make sure that all of those, similar or connected accounts are reconciled. The other thing I want to make as a point here about performance is that you look at a business here where the total assets are, about $850,000 as of the end of February, and we have $110,000 in credit card debt. Now that's a little bit of a yellow flag for me. That tells me that we are struggling to be funded with good capital, right? Interest rates for credit cards are always going to be pretty high, and so if you look at your balance sheet and there's a ton of credit card debt, it may be a signal that you're undercapitalized, meaning you don't have the right kind of capital in your business. You may want to try to look for a better loan or look for ways to pivot your business model. As we go a little further down the liability section, you're almost always going to have some kind of sales tax liability. And then you're going to have all of your short-term debt. Now, in the accounting world, short-term debt normally, and you kind of get to pick. You get to select if it's 6 months or 90 days, but you're going to pick some arbitrary, frankly, amount of time and say, this is a loan that has to be refinanced or paid off in less than 6 months. Okay, I'm going to put it in short-term liabilities or current liabilities. And then everything that's more longer term is going to go down here on the long-term liabilities, right? And again, if you're Coca-Cola, they would define it as a year. Everything that's got to be paid off in less than a year goes in the short term. Everything that's more than a year goes in long term. But to be honest with you, when it comes to e-commerce, so many of our lending platforms that you might find through like Sellerfi or Amazon Lending or PayPal Capital, almost all of those are less than a year in duration if it's not like an SBA loan. And so we have tended to try to use, a shorter timeline to differentiate between short-term and long-term debt. But at the end of the day, this guy's got about $480,000 in short-term debt. And if you think about it, his total cash in his business, going way back up here to the top, boy, is really small, right? We've only got a few K. Now this, I don't know if you're feeling your blood pressure go up, but when you look at this balance sheet, this should be signal that there's some strain, there's some stress on this business because we have a lot of debt and not a ton of cash. We're living on the margins here. Now we start talking about longer term debt that we got a little bit of a longer time horizon to pay off. And I want to point out a reality, and I want to point out an error to you in this balance sheet. I put these in here on purpose. But sometimes the shareholder, the one of the people who owns the business, will loan money to the business. They're not putting it in their equity side of the balance sheet. They're just booking it as a loan, and they're going to pay themselves back and pay themselves interest, right? But sometimes they keep paying themselves back and paying themselves back, and whoop, they've paid themselves back more than was owed to them. And so essentially you end up with a negative loan from the shareholder. And I just want to say this is one instance where you may see a negative account on your balance sheet and it actually be accurate. It just means that you loaned yourself money and then you took more than you loaned, and you're going to have to make it right at some point. The other thing that you'll see fairly commonly is a family member loan. Somebody puts a note payable on there that's long-term debt. That's pretty common. And then I want to show you an error here. So you can see this. There's a small paraffin loan here that's been paid down. It's been paid down. And then all of a sudden it goes negative. And this is not an owner loan. This is almost always going to be an error. And I'll tell you why. You're just booking the payments and you're forgetting to expense the additional interest expense. And so when I look at this balance sheet, I would probably be sending a note to my bookkeeping team saying, hey guys, looks like we forgot to, capture the interest expense in account 2540. Can you take a look at that for me? That would be the way I would quality assurance or QA this. But for you as either a customer of seller accountant or doing your own accounting or holding another firm accountable, this is again the way you do your analysis. I want to look month over month. I want to look for things that are strange. And I just want to ask the question, hey, is this strange because it's correct strange? Or is this strange because there's an error? Because I really want it to be accurate so that I can trust the numbers and, make the right adjustments. Like for instance, this is not a very healthy balance sheet that you and I are looking at here. We don't have a lot of cash. We have a lot of debt. And as a result, we're feeling a lot of stress, a lot of strain on this business. But let's say that we went back and realized, oh, psych, there's actually a whole nother checking account here from Chase, and we forgot to put it on here, and that checking account has $580,000 in it. We just forgot to report it to you. Do you realize how quickly that would absolutely transform this balance sheet, right? The health of this business would be dramatically better if you throw a $500,000 of cash into the middle of it. And so just making sure that you've grabbed every account and that every account is actually balanced properly so that you can see it. Let's talk about the last section of your P&L really quickly, your owner's equity. So remember, if you're kind of looking at this in the aggregate, if I were to go way up here to where it said total assets, and you can do this, by the way, for your balance sheet, total assets for February was $850K. Total liabilities, $562K. I can literally just subtract those. The 850 minus the 562 is going to give me an equity left of 286,000. And so what are the elements that make up the owner's equity section of your balance sheet? I think the one that's the most confusing, because here's what people normally understand. Okay, the owner made some kind of an initial investment, and the owner has taken some draws periodically out of the business to, either fund their lifestyle or to take owner distributions, whatever it is. This particular owner actually did some initial common stock and then made some additional investments. But here's the big thing. People are like, what in the world is retained earnings? How does this work? Let me explain it to you. As you can see here, going to the end of 2023, every month, literally, by the way, if I were to pull up this guy's P&L for October, he would have had a profit between January and October. So year to date of $9,000. And then year to date through November, $45,000. And then after December, for the entire year, his profit for all of 2023 was $168,000 and some change. And so here's the magic of the balance sheet is that now that we've accumulated all of our good news or bad news from 2023, something magical happens at the beginning of the next morning, right? So literally the ball drops and it's midnight on December 31st. Everything that was sitting in net income goes directly to retained earnings. And so you can see here where for all of 2023, retained earnings was just the accumulated earnings from all the prior years was at negative. We've lost money. By the way, this is common. If you do a startup, it's not uncommon for you to have to invest some cash and lose money for a couple of years before you're really profitable. Well, this one had accumulated $220,000 in losses. Well, they made up some ground in 2023 because they made a profit of $168,000. 220 minus 168 gives us a new retained earnings that is still negative, but negative to the tune of 53,000. And then we start our net income. So January's net income all by itself, 16,782. February plus January cumulative is 21,000. And so that's going to accumulate through the year 2024. Hopefully, he's gonna end the year above, the be in the black and make some money, and then that retained earnings will correct again going into 2025, and it will probably be a positive number now because he's now accumulated enough profits to overcome the old losses that he had booked. So I hope that makes sense. You're not going to spend a ton of time each week or each month looking at the owner's equity side of your balance sheet, but again, you need to understand the logic of it, and you need to make sure that it passes the sniff test, that these numbers make sense, because if they don't make sense, remember the adage, right? If I don't want my P&L and everything else to be BS, I want to make sure that my BS balances. So as you're holding your team accountable, or maybe you're doing your own accounting, just look month over month at recent months. Make sure that when it goes from the end of one tax year to the beginning of the next, that it makes sense, that those transitions are rational. Whenever you see negative numbers, I want to have a story. Maybe it's a story that's accurate, like this shareholder loan, or maybe it's an error where we forgot to book some interest. And this is a great way to make sure that I can always trust my P&L, is to say, is my balance sheet balancing? So this will be the end of the balance sheet part of our video series. Thanks for joining us. We'll see you next week as we continue talking about how to use your financial statements to make better choices.